Are you a beginner investor looking to optimize your stock options? Or are you a seasonal investor searching for new ways to spice up your option strategies? Well, fear not, as today we'll be discussing the best stock option methods as of 2021. Number 1. Buying calls. Also known as the long call strategy, this is one preferred by bullish traders who are absolutely certain on a particular stock, ETF, or index, all while minimizing the amount of risk. They may want to utilize their leverage whilst also taking advantage of high prices. A call, in general, just means that the buyer of the contract also possesses the right to purchase the underlying asset at a predetermined price, called exercise price. A long call involves buying your desired option. In the US, for example, a stock option holder has the right to buy 100 shares of any particular stock and sell 100 shares in the case of a call or a put. So, investors and stock option holders can buy these options as a way of minimizing their downside risk. So your long options position also doubles as an impromptu insurance policy by just setting a worst-case price and loss adjusted and limited to the premium you may have initially paid for that said option, just in case your market view turns out to be wrong. And your plausible profit is essentially limitless, as the option payoff will increase as the underlying asset price does until expiration. So, technically, there is really no lid on how high your profits can go. Number 2. Buying puts. Also known as the long put, this version of the long option strategies is perfect for investors who are bearish about a particular stock, ETF, or index, and believe it's destined to have a downward trajectory. So, to take on less risk and to utilize leverage and take advantage of low prices. A put option, as opposed to a call option, the buyer possesses the right to sell their underlying asset at any time in the future at the predetermined price. A put option works the exact opposite way compared to a call option. As the price of the underlying increases, the put option gains value. And while short selling may allow an investor to profit when prices go down, the risk that comes with a short position is limitless. As in, there is no limit on how much a price may rise. And with this option strategy, your options may just expire worthlessly if the underlying rises. So, to summarize, this option strategy holds the potential for loss is tied to the premium paid for the options. But there is a limit to how much profit one can secure. Number 3. Covered call. The perfect stock options method for traders who expect only a slight increase, if any increase at all, in the underlying price is covered. Investors who prefer this are often also open to limiting their upside potential if it means they get downside protection. The strategy involves buying 100 shares in an underlying asset and then selling a call option against the said shares. So when the investor may sell their call, the options premium can be collected, which lowers the cost basis on the shares, and as such, provides downside protection. In return, by selling the option, the investor agrees to sell their shares of the underlying at the option strike, or predetermined price. This caps the trader's upside potential. So if your share price rises before reaching expiration, the short call option may be exercised. This means that the investor will have to provide the stock at their option strike price, thereby raising profits. As long as your shares do not rise above your strike price before expiration, this short call or calling away option may be exercised. This will lead to you being asked to deliver shares of your underlying at the option strike price, even if it may be below the regular market price. In exchange for this mild inconvenience, a covered call strategy will provide a decent amount of downside protection in the form of the premium received while selling your call option. Number 4. Married put. This strategy refers to an investor buying an asset, perhaps in the form of stock, and also buys put options on the same amount of shares, all at the same time. The investor, or the holder of put options, therefore has the right to sell stock at its strike price, and each contract must be worth 100 shares. This strategy may be chosen especially to protect your downside risk when holding stock. It can also be called an insurance policy since it works like one. In the case of stock prices falling rapidly, this strategy has an established, designated price floor. But all the while, the investor is easily able to take advantage of any upside opportunity, lest it presents itself in the form of stock gaining value. The one disadvantage of this strategy is the loss the investor must face in the premium paid for the put option if the stock doesn't end up falling in value. So the money you end up losing is small and insignificant in value. Yet, it also participates in any gain opportunities you may have thanks to price appreciation. Number 5. Bull call spread. In this strategy, an investor or trader will purchase calls at a particular strike price whilst also selling the same number of calls at a marginally higher strike price. Both of these call options share an expiration date and an underlying asset. This is also called a vertical spread strategy, an option strategy that involves buying a call and selling another call at a different strike price at the same time. Vertical spreads decrease both risk and the potential for return and are used when the investor is more bullish on the underlying asset, or if they expect a decent-sized increase in the price of the asset. Using this strategy, the investor can limit their upside on the trade, all whilst decreasing the net premium spent. For the strategy to be executed to perfection, the stock price needs to rise so that a profit can be made on the trade. The trade-off of this particular options method is that an investor's upside is low. When outright calls are expensive, it's only reasonable for one way to offset a higher premium to sell even higher strike calls against that. Number 6. Protective collar. This strategy calls for the investor to buy an out-of-money put option, which is an expression used to describe an option contract that only contains the extrinsic value. To put it simply, the OTM call option has a higher strike price compared to the market price of the underlying asset. Anyway, the catch is that an investor would be writing an out-of-the-money call option, and the expiration date and the underlying asset must be the same. This strategy is mainly utilized by investors who are dealing with a stock experiencing substantial gains after a long position. This strategy also allows investors to have downside protection. That is, the long put helps them lock a probable sale price. However, the catch? You may be obligated to sell your shares at an increased price, thereby losing your shot at grabbing future profits. The protective collar strategy is also a neutral trade-off, which, in simple words, just means that the investor is protected in case the stock falls. The trade-off itself is the obligation to sell the long stock at the shorter call strike. But the investor will most probably be glad to do so since they've already had gains in the underlying shares. Number 7. The protective put. The protective put is a strategy preferred by investors who own the underlying asset and desire downside protection. So the protective put is kind of like the long put, as we discussed before, except the main aim here is downside protection, as opposed to attempting to get a profit from a downside move. And if a bullish trader owns shares but wants them protected against a decline, in the long run, they may buy a protective put. Say the price of the underlying increases and is above your put strike price. Your option risks getting expired worthless, and you may lose your premium. Of course, you'd still have the benefit of increased underlying price. But in a different scenario, if the underlying price decreases, your trader's portfolio risks losing value. This, of course, is an unlikely scenario and is covered by the pain from your formerly mentioned put option position. Hence, the position is more insurance than most things. You, as the trader in charge, can set the strike price below the current price just to reduce the premium payment at the expense of decreasing downside protection. So, in other words, deductible insurance. On the other hand, if you're able to tolerate some level of downside risk, choosing a less expensive, out-of-the-money option may also work. So, assuming the price of your underlying stays the same, or even if it varies, your potential loss will only be limited to your option premium. However, if the price of the underlying drops, the loss in your capital may be offset by the option's price rising. This will only be limited to the difference between the initial stock price and strike price, and the premium paid for the option. And with that, it wraps up this video. Thank you for watching. If you enjoyed the video, be sure to leave a like and comment your thoughts down below. Also, subscribe to the channel and turn on post notifications so you never miss a video again.